If you are waiting for the housing market to crash so you can finally buy a home, you are not being patient. You are being quietly priced out by math. In a normal economy, high interest rates destroy home prices, but this is not a normal economy. Mortgage rates are above 6%. Home prices are at all-time highs. That is not a bubble. It is a structural reset. And if you are still playing by the rules of the 1990s, saving cash, waiting for rates to fall, you are walking into a trap that does not reopen. If this feels wrong, that's because everything you were taught about housing assumed one thing, that sellers are forced to sell. That assumption is now broken. We are entering 2026 with a massive disconnect. Mortgage rates remain high, yet home prices refuse to fall. Here's why. Over 80% of current homeowners have a mortgage rate below 5%. Many locked in at 3% or less. Selling their home would mean doubling their interest rate. They are not emotional about this. They are mathematically incentivized to never sell. This is called the lock-in effect. It has frozen housing supply. And when supply freezes, prices stop responding to interest rates. This is not a bubble waiting to pop. It is a permanent reset of the barrier to entry. At this point, most people say, "I'll just wait for the Federal Reserve to cut rates." That belief is about to cost you years. Here's the reality the headlines will not explain. Mortgage rates do not track the Federal Reserve. They track the 10-year Treasury yield. And right now, the United States government is running massive deficits. To pay its bills, it must issue enormous amounts of Treasury bonds. When bond supply floods the market, yields rise. When yields rise, mortgage rates rise. As long as the government spends more than it earns, mortgage rates have a mathematical floor around 5 to 6%. The era of 3% mortgages is not paused. It is over. So now we arrive at the real question. If rates are high and prices are high, how do you win? You stop looking at monthly payments and start looking at unrecoverable costs. Let's run the math. A $500,000 home. A 6.5% mortgage. 20% down. You borrow $400,000. Your monthly payment is roughly $4,000. But most of that money is being incinerated. First, mortgage interest. In year one, roughly $2,100 per month goes purely to interest. This pays down zero debt. It is a fee paid to the bank. Second, property taxes. Nationally, this averages about $625 per month. This is a fee paid to the government. Third, maintenance. You must budget 1% of the home's value annually. That is $416 per month. Fourth, insurance. Due to climate risk, premiums have surged. The average cost is roughly $250 per month. And fifth, opportunity cost. You trapped $100,000 of cash in the house. If that money were invested earning a conservative 8%, it would generate $666 per month. By buying the house, you lose that income. Add it all up. The homeowner is burning $4,123 every single month. Now look at the renter. That same home rents for approximately $2,800 per month. The renter pays no property taxes, no maintenance, no insurance spikes. Their total unrecoverable cost is $2,800. The verdict is clear. The renter is saving roughly $1,300 every month. Now let's address the objections. First, the tax write-off. For 90% of people, this is a myth. The standard deduction for couples exceeds $32,000. Most households do not itemize. Unless your interest expenses are extreme, you receive zero tax benefit from owning a home. It is a phantom perk used to sell loans. Second, rent goes up, and my mortgage is fixed. Only your principal and interest are fixed. Property taxes rise. Insurance premiums rise. Maintenance costs rise. Your so-called fixed payment increases every year. Meanwhile, the renter invests the monthly surplus. Historically, market returns outpace rent inflation. Now let's talk about appreciation. We'll run a 10-year simulation. Lane 1 is the homeowner. The home appreciates at 4% annually. After 10 years, it is worth roughly $740,000. After paying down some debt, you have $405,000 in equity. But to touch that money, you must sell. After agent fees and closing costs, your net liquid cash is $346,000. Lane 2 is the architect. You invest the $100,000 down payment. You also invest the $1,300 monthly savings. After 10 years, your net liquid cash is $463,000. The renter wins by over $100,000. Why? Because in 2026, the cost of capital consumes home appreciation. Now let's address refinancing. People say, I'll marry the house and date the rate. This is the refinance trap. Refinancing typically costs 2 to 5% of the loan amount. On a $400,000 loan that can approach $20,000, and you reset your 30-year amortization clock. Back to mostly interest. You didn't escape the trap. You paid to reset it. There is one honest truth. Homeownership works for many people because it is forced savings. You must pay the mortgage, or the house is taken. Most renters fail because they spend the surplus. To win, you must be deliberate. This is the Liquid Fortress Protocol. Step 1. Automation. Open a brokerage account. Automatically invest the difference between renting and owning every month. Treat it like a bill. You never touch it. Step 2. Inflation hedging. Invest in broad market ETFs and REITs. Real estate investment trusts give you exposure to real estate without illiquidity, repairs, or taxes. Most importantly, your capital remains liquid. If you need to move, if you lose your job, if opportunity appears, you are free. The homeowner is trapped. The architect can move. Buying a home is a valid lifestyle choice. It is stability. It is memory making. But stop letting society convince you it is the only financial path. In 2026, liquidity is the ultimate luxury. Do not buy the cage because everyone else did. Rent the luxury. Invest the surplus. Build the fortress. I'm Arcan. Welcome to the new reality.